Imagine you are sifting through vast amounts of financial information, perhaps looking at stock prices, transaction records, or quarterly earnings. Suddenly, a number just does not look right. It stands out dramatically from everything else. How do you confirm it is an anomaly and not just an unusual but valid data point? How do you reliably spot these critical deviations? Detecting outliers in financial datasets relies on a variety of methods designed to identify data points that significantly deviate from the general pattern or expected behavior. These methods broadly fall into categories like statistical techniques, distance-based approaches, density-based methods, and machine learning algorithms. The core idea is to flag observations that are unusual enough to warrant further investigation, as they could signal errors, fraud, or significant market events. The why behind these methods often relates to the distribution and nature of financial data. For data that is normally distributed, simple statistical methods are often effective. For instance, the z-score method measures how many standard deviations a data point is from the mean. If a data point falls beyond a certain threshold, like 3 standard deviations, it is flagged as an outlier. Another robust statistical approach is the interquartile range, or IQR method. This technique identifies outliers as data points that fall below the first quartile minus 1.5 times the IQR, or above the third quartile plus 1.5 times the IQR. This method is particularly useful because it is less sensitive to extreme values than the z-score, making it suitable for data that might not be perfectly normal. However, financial data is frequently not normally distributed, and relationships can be complex. This is where more advanced techniques shine. Distance-based methods like k-nearest neighbors identify outliers based on how far a data point is from its neighbors. If a point is isolated and far from most other points, it is likely an outlier. Density-based methods, such as local outlier factor, or LOF, assess the local density of a data point compared to its neighbors. A point in a region of low density is considered an outlier. Furthermore, machine learning techniques like isolation forest or one-class support vector machines are powerful for high-dimensional data, working by isolating anomalies rather than profiling normal data points, often by partitioning data randomly until outliers are separated. Applying these methods often starts with understanding your data's characteristics. You might begin with simpler statistical checks to get a baseline, then progress to more sophisticated algorithms as needed. For example, when analyzing transactional data for potential fraud, you might first use the IQR method to detect unusually large or small transactions. Then, for more subtle patterns, you could apply an isolation forest model to identify complex, multi-feature anomalies that a human eye might miss. The key is to iteratively refine your approach, often combining several methods, and always incorporating domain expertise to interpret the findings. This iterative process helps ensure you are not just finding statistical anomalies, but financially significant ones. A fascinating insider detail in financial data analysis is the concept of black swan events. These are extremely rare, unpredictable events that have severe financial impacts, like the 2008 financial crisis. While most outlier detection focuses on identifying deviations from existing patterns, understanding and preparing for potential black swan-type outliers requires robust, adaptive models that can handle unprecedented shifts, or at least flag them immediately for human review. Another interesting aspect is data drift, where the underlying statistical properties of the data change over time. An outlier detection model trained on old data might miss new types of outliers or flag normal data as anomalous if data drift is not accounted for. Mastering outlier detection methods significantly enhances your ability to work with financial datasets, ensuring data quality, identifying potential risks, and uncovering hidden insights. By understanding and applying these diverse techniques, you move beyond just seeing numbers to truly understanding what those numbers are telling you, strengthening your analytical capabilities, and contributing to more robust financial decision-making.